Welcome to Let's Talk Investing, a co-production of the Globe and Mail and the Investor Education Fund. I'm Rob Carrick, personal finance columnist at the Globe and Mail, and with me is Kathryn DelGreco. Kathryn is Vice President at TD Waterhouse and an investment advisor. Kathryn, what kinds of investments do you suggest I put in my child's RESP?
Well, I think like any investment strategy, you need to take a look at certainly your personal risk tolerance level and consider this as an asset class within your household of assets. So I would certainly, if I am a low risk investor, I'm certainly not going to all of a sudden embrace a real aggressive strategy inside my RESP. However, I would say, given the age of the child...
Let's say I'm starting off for an infant. We might have 17, 18 years till we start drawing on this. How aggressive can I get if I'm comfortable with risk?
If you're comfortable with risk, I would absolutely wholeheartedly recommend getting a good equity fund that's got a great 10-year
so I can go into the
record.
stock markets, no problem.
Absolutely, because I think it's going to give you the best bang for your dollar.
Okay, now, let's say we're getting up, my child's 15, 16, we're looking ahead in a year or two, they're going to university. How should I change the holdings in my RESP?
You absolutely should start to move more conservative and start to parcel off certain amounts of money. If you know you're going to need to make a withdrawal within the next 1 to 2 to 3 years, start to parcel out that $5,000 or $10,000 and start parking it in more conservative investments.
So I could put that in a money market fund or in a 1 or 2 year GIC?
Absolutely.
It sounds to me like it's a little bit like planning for retirement, where I'm going from the accumulation phase, building up money, to the phase where I'm going to need money and I have to know it's there. I'm going to need to sort of take chunks of my money and invest it very safely. You're doing exactly the same thing with RESPs?
It is at 100% exactly the same thing. When you need to rely on that money and you need to know for sure that it's there, you better start to parcel it out and put it into preservation mode.
So once my child's in university and going, am I pretty much 100% fixed income, GICs, that sort of thing, safe things?
Well, certainly if you only have one child who's a beneficiary of the RESP, then I would think that would be the smarter thing to do.
Now, if I have, let's say, a younger child, say in 5 or 6 years, then I may want to keep some equity exposure to build up the assets.
Absolutely. You're going to look at an asset mix that's probably a combination between the preservation you need for the child who's in need of funds, but certainly that child that still has 5 to 7 years before that money's needed.
All right, so it's a mix of preservation and growth. One last question, scholarship trusts. That's where investors band together, they put their money together with these scholarship trusts, they're invested in pretty safe investments, but a lot of fees and conditions with those products. I'm just curious what your take is on them.
With all due respect, it's something that I'm not as big a fan of. Fees are rather excessive, and I do find the limitations and restrictions somewhat restrictive. So I prefer to have a family plan where my clients can have control over their own asset mix and we can really have a transparency over fees.
Great, thanks a lot, Kathryn.
You're welcome.